Good morning. Welcome back to the Retirement Report. I'm Hank Parrott, your host. All right, one of the things I forgot we want to put out there, you want some help with your taxes? Would you like, it's a part of a comprehensive financial plan. Anytime we're talking about planning, it's not just what you make, it's what you keep, and that means not giving so much to the IRS, right? We want to keep more of those dollars in your pocket. And there's so many other areas that applies when it comes to your investments. What are you paying in fees? What are your costs there? Because there's another way, when you're paying a lot in costs, that's less that you're going to be making. How are you investing? How are your portfolios put together? Because it's not just the cost piece. I'll give you an example of this. I looked at a Vanguard Target fund recently, a 2025 fund, and that's about that 2025 fund has 60% approximately in stocks and 40% in bonds. Now I looked at that and I compared it to the model portfolio that we use in my practice, and the model portfolio is based on Dr. Fama's three-factor model. He won the Nobel Prize in 2013 in economics for his work in equity research, and so we use that model, and it's been, when I compared that model, for instance, to the Vanguard model, and the Vanguard model over the last 10 years averaged about 5.7, 5.8% per year with a standard deviation, so that's the risk or volatility measure of about 12. Compared that to the Dr. Fama's formula, and what we've got there, 60-40 formula on that same 60-40 type of asset allocation, we end up with a 7.7, almost 7.8% return, 2% more per year. Now that's significant over 10 years. Are you talking 2% compounded per year? Woohoo, right? So that's a lot of money in your pocket, and yet is the most interesting part to me also, not only was the return higher, but the risk was lower. The standard deviation was 10. So we had we ended up with about a 40% increase in return and a 20% reduction in risk. This is asset allocation, the science of investing. And you need to understand that, because there again, that's keeping more money in your pocket and less going out in fees, less going out just from a lack of efficiency in your portfolio. And tax efficiency in investing is another area that we get into. When we're looking at how that portfolio is put together, the next piece of that is where, on stocks and bonds, they have different ways that they're taxed, and how you then invest and what kind of accounts you put them in is also important. You want to get a better understanding of all this besides watching us here today? Call my office, 615-376-5325. Tess is standing by to take your information. She'll send you out a checklist of things to bring, a little questionnaire, and then a checklist of things to bring to your appointment with me, and we will do up a full comprehensive financial plan. So it's not just a free consultation where we sit around and talk and drink coffee and all that kind of thing. It's much better. We do give you the coffee still, though, and chocolates. But you come in, what we'll do is we're going to do a full comprehensive plan. So we're going to show you your financial future, in essence, based on the things you're doing today. I can show you what your financial future is going to look like, because we're going to factor in things like inflation, taxes, of course, the rates of return on your investments. All of this is factored into your planning. We're going to look at your income, your expenses, your assets, your liabilities, and through that we're going to be able to show you your financial future, what it's going to look like for you 10 years, 15, 20, 30 years down the road even. I had some people in earlier this week that want to retire in a couple of years when they're still, when about their mid-50s. When you look at longevity, people are living easily into the average lifespan for, I think man now it's 83, and for the woman it's 87. For the average couple, age 65, right? We won! And I think it's something like a 50% chance that one of them will reach age 95.
Wow.
That's what's longevity. This is serious. Adding a lot of risk to the portfolio. When we come into financial planning, there you go. That's exactly it. Because it multiplies out your risk, doesn't it? The longer you live, inflation is a bigger deal, right? Your purchasing power, protecting that. If you're going to, if you're planning to die in the next 5 to 10 years, less of a problem. All right,
if we could actually organize our schedule that way, that would be great. But most of us don't.
Yes,
but
we don't know.
And almost only because that is why I wanted to point out on this last one. You were talking about how much people were saving per paycheck, kind of thing. Why aren't people? You've been living without that money already. It's not money that you've basically. This is a tax rebate to you as an individual. Increase your 401ks. Increase your 403bs, whatever you might have at work. If you have an IRA or personal SEP, just use that money as if it doesn't exist, and you could put $100, $150 more a month or per pay, depending on how it works. I don't, depending on the individual. You might want to wait and find out what that change is, but reduce your check and start putting it. That's going to be tax free. It's going to be deferred to the to retirement.
Or
and
at
this would
least
be money you never really counted on anyways. This is a gift. So why not make that gift keep on giving?
There you go.
You know?
Save it. You know, and
So,
whether,
it'd be
or at
easy.
least some proportion of it. I mean,
Because
if you
the
take,
average
say,
person
half
has
of it.
$500. He's one always $500 in savings. That's the average American has as an emergency fund. $500. We need to change that.
Yeah. And this is one of those areas, and there's been lots of research on this talking about the fact that majority of Americans couldn't afford a $1,000 emergency. This kind of thing, yes, this is where planning comes in, and this is the other part. When we do planning, and the purpose when I tell you I'm going to show you your financial future, while you still have a chance to do something about it.
Exactly.
Okay, and if you're already retired, if you're already just wanting to make sure that you don't run out, this is another area. It's the same concept. All right, maybe the time frames differ a little bit, the way we do it's a little different, but the concept is much the same. Is looking at the things you're doing today, and is there a way to improve them that will give you a better result in the future? And that's what we're talking about with a comprehensive plan. So again, if you're one of the first 10 callers to my office at 615-376-5325, we're going to do that for you. We're going to give you a checklist of things to bring to your appointment with me. If you want to get into the tax planning, if you need some help with taxes this time of year, we can have Dr. Friday meet with you as well. We can meet with you together, in fact. So again, for the first 10 callers, 615-376-5325. And when you come in to see me, I'll also give you a free copy of my book, 7 Steps to Financial Freedom in Retirement. All right, so again, first 10 callers, there you go. Tess is standing by. She'll get your information. She'll send you out the checklist of things to bring. And when you come in to see me, again, a free copy of my book, 7 Steps to Financial Freedom in Retirement. And in there, I get into how the whole, the introduction talks about how we come to be where we're at today. It's not like our parents and our grandparents had, pensions, Social Security, and their savings was just kind of like a little, emergency nest egg. They rarely touched it. Today, we need those savings to supplement our income, because fewer, only about, I think it's less than 20% now, have pensions in the country. So, and those, I see people coming in all the time. Even those with pensions, I see, some very small pensions, like a couple $100 a month or something.
Exactly. They're like the end of the whole pension generation is now coming through, because I see people have received $2,000 or $3,000 for the whole year in a pension of some sort that was passed down or
and it
whatever.
Definitely isn't going to make a big difference in terms of as far as your life goes. So what we're talking about, much more important, is things like just a 20. This is to what Dr. Friday was saying earlier, a 20% reduction in your taxes. Think about that. All right, look at what your taxes were last year. See, 20% less.
Do something. Yeah, I'm thinking I'm really liking those numbers. I mean, being in the world of self-employed and different types of taxation that we deal with, it's not going to always feel dollar for dollar. But the fact is, I would be happy with a 5% reduction. I mean, a reduction. I mean, anything is a reduction. But I will say, I had a client come in. No, he didn't come in. He called me the other day, and he kept hearing, and this is right along here. He's like, I took money out. I'm debating if I want to put it back in because it changes my taxes this year, but I've heard that the market is going to crash or go down drastically. So I'm thinking I need to hold on to that. And I'm like, well, is that all the money you have in retirement? No, it's just a very small mix of it. And I'm like, so you're still going to lose a big chunk. What's the difference? And if it goes down by 2 or 3%, because we've had a really nice market, and I don't follow the market, as anyone knows. That's not my expertise at all. But you can't turn on the news and not hear how good the market's been doing. And I'm like, well, if it comes down, you're still growing your money, right? I mean, it's still growing. So what do you consider a crash? Are we going to go upside down? I mean, and so he's like, I mean, that's why you do what you do, which is diversification, cover this stuff, right?
Exactly. It's one of the ways that you
don't want to take it out and pay taxes and lose. How
you're invested, you can have defensive strategies.
Right.
So if you're invested in such a way that, yes, we don't know, is the market going to continue the way it is? At some point, we will have a correction, we'll have a bear market.
Exactly.
We know that. We don't know when. So we plan for it, though. When we put together an investment plan, we have it set up in such a way that if the market drops, we're going to be protected, okay? We've got a way to weather that so that it doesn't change our standard of living, quality of life. You're able to still do that, and that's the way your investment should be set up.
Right.
If you're rising, if you're worried about the market going down, and you're in 100% large caps as far as your investments, yes, when the market drops, you're going to drop major league with it. But if you have a better investment strategy than that, if you understand the importance of asset allocation and smoothing out that volatility, as I talked about earlier with Dr. Fromm's formula, as the 3-factor model, think about that, all right? 20% less risk, 40% more return. if we compare that to the market, it's the same concept. If I take that same portfolio compared to the market, I give up maybe a 20% of my return to get a huge, are you ready for this, right? We're talking about a 40% reduction in my risk.
Right.
Right, so there are ways that you structure it according to what your own needs are and what your needed rate of return is, understanding how that works. And here's another thing, this goes to the person you were talking about. When it comes to understanding the difference between your investing strategy and tax implications.
Right.
All right. So what happens is you can get tied up thinking, oh, I'm going to take this money out, but I'm worried about putting it back in. There's a big tax benefit to doing so, but if I do it, he's thinking that he has to invest it in the same way. You don't have to. If you're worried about the market dropping, change the way you're investing. If you're
put it in a secure place where it doesn't have to even be changed.
An IRA doesn't have to be invested in stocks and bonds. It can be in a savings account. It can be in a money market account.
Not
if that's
not
what
a
your
good
worries
advice,
are.
probably, because there'd be absolutely no growth to inflation, and we'd probably be upside down sooner than you like. But I agree, that is the kind of thing you have.
All right, we got a caller, so we're going to grab this. This is Pat. Pat, welcome to the Retirement Report.
Hi. I have a question. I am single and retired. I'm 65. I looked forward to my new pension payment this month, and I expected it to be slightly larger. Are they not? I assumed it was going to be the 1st of February, but is it going to be phased in or company by company or what?
Well, the IRS asked everyone to wait till after February to make the change, so it could be that. But if you mention a pension, if you requested to have a certain amount withheld, normally on a pension you say 5%, 10%, whatever you want, that may not be changing.
Oh,
so if you set
I did have 10% taken out and an additional small amount taken out monthly.
Right, and you may want to contact them, once you get your 2017 taxes. If you talk to your tax person, ask. It may be that you can move that down instead of having the additional, stick to the 10%, depending on what the scenario might be. You might actually have to wait till 18 to find out what the change will be, depending on your tax person and how they're good at projecting. But, bottom line is, most people on pensions or on RMDs and all them, they ask for a specific percentage to come out, and that will not change no matter what.
So,
Thank you very much. I appreciate that.
Thanks, sweetie.
Sure thing. Thanks, Pat. Bye. So this goes to with withholding, in particular, like with pensions and that, calculate out what the new tax. Because if it's not wages, it's not going to be automatically done for you. So if you have 10% withholding, or if you had 15%,
that's a great question, though, because a lot of people, all you hear in the press is, "Oh, I'm getting more of my checks," know, and no one ever thinks about there's so many different ways people get their pay, right? I'm just saying. So that was really a great question, but
so calculating out what your taxes are and maybe adjusting that withholding on your own, so you can drop that 10 to 8.
She said she's 65. I wonder if she turned 65 last year, because that will also change her standard deduction. In the year in which she turned 65, she just got a larger bump in her
for a single person. If filing single, it's a little higher. So for a married couple, it's $1,250 is the extra deduction that you get, but for a single person, I believe it's $1,550. So again, understanding that, calculating out the taxes, doing a little advanced planning, because that's also why give them more money to hold on. They don't pay you interest on that money, right?
Yeah, that was in 17. I think in 18, it's actually all straight across the board.
Oh, did they just? All right.
They simplified
catch me up then. All right, so $1,250 either way, single or married. And then $1,250 for a couple, it'd be $2,500.
But either way, she's got $1,250 at her income. That's free money this year, because in which she turned 65.
Yeah,
and then, of course, in 18, she's going to even have a bigger chunk,
and potentially
lower tax rate. So she'll probably see a nice little chunk. And I'm big on not letting the IRS keep my money if I don't have to. I'd much rather have it on my paycheck or in my pocket, and then let them, work with what they get.
Okay. We're going to take another break. When we come back, we're going to talk about there are some strategies that we used last year and that we'll be using this year, and we're going to talk about those and how that works, both for the purposes of minimizing taxes this year, of course, for filing for 2017, that is, as well as for tax planning for 2018. So join us here. We'll be right back on the Retirement Report.